Good morning, class. I'm going to be posting the lecture early this week. I'm going to be in a place where I'm uncertain of the quality or even the availability of an internet connection capable of hosting this class on Tuesday evening. So I'm posting it early. I apologize for that, but thank you for allowing me to do it this way. This happens to be early on a Sunday morning. I'm about to catch a flight in a little bit, and anyway, the good news is for me is that this week's travels will take me to the San Juan Islands in northwest Washington, very near the Canadian border, and we'll be sailing on a boat not quite that big, but not too far off. So I'm just not really sure what this is going to be, and it's a what we would call in the business, I don't know, it's a trip with a significant vendor partner of ours. So just want to make sure that we got the class posted and everything kept moving along, so I'm posting it early. All right, the next thing to the homework, the thing we've tried to do here is you can remember that when we did in class, we had that proprietorships were personal, liability, the taxation was personal. It was really hard to get outside money just because if somebody was just loaning it to you. It was really easy to set up and govern it because there wasn't any. And usually a proprietorship is one person. And you can see as it moves across that, you know, a partnership is, you know, it's the liability is personal, LLC, company only, company only, company only, company only on the liability. The taxation is personal all the way across except for the big C corps, for the big companies or people that want to be big companies like mine would be typical C corps. Ease of raising money, it's, you know, yeah, it's harder. It's a little easier, a little easier, a little easier, a little easier, easiest. So whatever you said in this range in here, from hard, super hard to impossible to, you know, a layup, anywhere along that continuum is fine. And you don't have to use these specific words that I had put in the kind of the hints down here, but certainly if you use those exact words, it would be harder, easier. Actually, LLCs probably fairly easy too. So if you said easy under LLC, that's going to be an acceptable answer. And then under setup and governance, you know, it's very easy here because there is none, and it's much harder and more expensive out here in the C Corp, S Corp land, and in the LLCs and partnerships, it's easier and cheaper. And by the way, the vast majority of all companies set up today are LLCs right in here. The crosshatch. And then typical users, this would be a person, you know, a couple of people getting together. LLCs, it kind of depends. It could be one person who's just trying to defend themselves from the liabilities, up to very, very large corporations, or LLCs, as it will. And then, you know, these usually get into the bigger groups. I don't think that's right. I think in an S Corp you can only have so many. Oh, you can't have two classes of stock. That's what it is. All right, and then on the taxes, the point I'm trying to make here is that all these other people that get taxed at the personal level, if all they're paying is 20% taxes at the personal level, and they made $100,000, there's taxes of $20,000. But if you're paying at a corporate tax rate of 39%, and you only have $39,000, you paid $39,000. $100,000 minus 31 is 61. If you distributed all that out to the owners, they would pay 20% taxes, which is $12,200. So the $39,000, what? Okay. Times the $12,200 is a $51,200 in total taxes paid in a C Corp because of, one, it pays corporate taxes, and then if you pay the dividend out to the owners, you pay the profits out, you pay taxes twice. There's the double taxation, which is why on this side we say in taxes it is double taxation, right? Okay. That's what I want you to understand. For me, if you lay it out like this, you see it on a continuum, on a grid, or whatever, it gets pretty easy to see. And this is just really, hey guys, I'm just trying to overemphasize the point of the tax advantages of all of these, and particularly the most popular form is an LLC. You can see the tax advantages, you can see the setup and governance advantages, and you can see the liability advantages. So it's pretty clear why an LLC is the most popular format. Now, to intro, we are, as you know, we have a student in the class who we want to accommodate fully who has some challenges as it relates to visual on traditional formatting, and so the school is trying really hard to make sure that we've got appropriate materials available to the student, and so they are posting things to the course shell that may or may not be confusing to you, but they are to me in some cases. So I just want you to bear with us and use common sense and make sure that you're staying on top of things and just go ahead and read it. So I noticed that they had, for example, it said read chapter 2 is what I had written, and then they posted a PowerPoint about chapter 2, a link to the PowerPoint about this chapter 2 next to it. Now they did not want you to think that you could just look at the PowerPoint and that would be sufficient. I don't believe that is correct. I think you need to read the chapter and textbook. Okay, now on to my favorite subject, money. All right, let's get into the subject matter here. All right, because what is finance about anyway? Money. All right. Sorry, I'm sipping hot coffee. The point is fairly academic as it appears, but really in a well-functioning economy like the United States, for example, probably the best functioning economy in the world, money or capital moves around real efficiently. And it moves from those people who have it to those who wish to consume it. Now that doesn't mean you just wish to consume it because you want to consume it. You want to utilize it, is probably a better word. You want to utilize it for the betterment of the people who put the capital with you and for yourselves and for others. So who has that money? It's usually what the bank calls savers, but it's really people who are supplying capital or depending upon the situation, individuals or institutions that have money, and the book calls them excess funds. In some cases, they are funds that have been saved over a period of time for the specific purpose of supplying capital to others. So these groups are saving money, and when they give you their money, and they are going to let you use their money, they want to get something for it. And usually that means a rate of return. If it's a bank and they are loaning you money, you're going to pay an interest rate. If you borrow money on your credit card, you're going to pay an interest rate. And so the question that you're going to have is, if I'm going to use this money in my business, how much is it worth it to me to pay? What is a good price? So who are the people that are the demanders, or really the users? I used the word consumers earlier. That's not really a good choice of words. But who are the users of the capital? They are, this is individuals and institutions. I'm going to say they are businesses that need to raise money to further their business. They will pay to get access to that capital because I think it's worth them. So how do we get the money, this really efficient flow of funds and money to people? Well, there's a few ways. The ones that they're really kind of direct transfers and then indirect transfers. And the direct transfers are friends and family. So, you've got your lawn mowing business or cabinet making business, and you've been doing it all yourself out of your garage, and now it's time you want to hire some employees, you want to buy some more materials, perhaps you want to buy a facility, a building to rent it from, and you need some capital to grow because you see the opportunity, you just need some money. So, typically you would go to your aunt or your uncle that has a little money and say, could you loan me $20,000? Could you invest in my business? And they would give the money directly to you. Indirect transfers would be where probably the bottom example is the easiest example, is it's a financial intermediary like a commercial bank. For example, the American National Bank of Texas in Rockwall, or Wells Fargo, banks where you go borrow the money and they loan it to you, right? Indirect transfer. Also, because they're really not loaning you their money in essence, they're loaning you money based upon the deposits other people have made in that institution. So they are a financial intermediary. The indirect deposits are made, an indirect transfer to an investment bank would be, you've probably heard these names, J.P. Morgan, Morgan Stanley, Credit Suisse, Barclays. There's a bunch of them out there. And they are people that raise money from other people to put into your business. It could be debt, it could be them buying stock in your company, and they go out and find investors who will put money in your business for you. And so they are an investment bank, so they go find investors for you as opposed to sitting on somebody else's deposits and then they lend them to you. So what is a market? Seems like a simple question is. But it's a venue. It's a place where goods, services, and money are exchanged, right? And a financial market is a place where financial products are brought together to buy, sell, swap, trade, bet on financial instruments. So it seems kind of simple, but it's going to make sense in a minute. So what types of financial markets are there? Well, clearly think about it, there's physical assets and there's financial assets. So if you think about physical assets, you could think of equipment. Surely there's, you can get a price for gold, real estate, cattle, cotton. And so literally there are exchanges. Anybody ever seen the movie with Eddie Murphy and Dan Aykroyd, Trading Places? And that's a physical asset market because the movie's kind of based around trading orange juice futures, I think it was. And so, there are, in fact, if any of you are from Northeast Texas and there happens to be a cattle sale barn in your town, that is a physical asset financial market where people are buying and selling cattle. Cotton was a huge thing in Northeast Texas for a long time. In fact, if you think in Dallas, the annual football game, that's the big bowl game, is the Cotton Bowl. There is a stadium in Fair Park that is the physical Cotton Bowl. There was an exchange in downtown Dallas that was the Cotton Exchange, where huge amounts of cotton was bought, sold, insured, traded, futures, etc., were hedged on. So there are those physical asset markets. Now, the financial assets are the ones that most people think of when they think of markets, because they think of Wall Street or the pictures from the movie Trading Places. So what do you trade there? Typically, you're trading stocks, bonds. You can trade mortgages. If anybody's seen The Big Short, that movie, or read that book, certainly about trading mortgages. There are all kinds of people that will take options to buy your stock. They will pay a certain amount to buy an option to buy your stock. They don't actually buy your stock. They just have an option to buy your stock. So if it goes up, they can make a lot of money. If it goes down, they've only lost so much. So typical financial instruments. Stocks, that means that you're there trading shares of or a percentage ownership of companies that are being traded on a daily basis in huge volumes. Millions and billions of shares get traded every day. As it relates to the options, there are spots and future markets. The spot market is, what is something worth right now today? If I want to sell you 100 shares of Disney right now, what do you pay me for it? And what will I take for it? That's the spot market. What will you take right now without any pre-planning what's the price, and it's kind of an arm's length agreed price. As opposed to, there are clearly futures markets. So, and I talked about it a little bit when I talked about options, which means I will pay you now for the right to buy something in the future at X stated price, or perhaps I want the right to sell it to you in the future at a certain price. And any of you that are involved in agriculture probably would be aware of, particularly on crops, would be aware of hedging. So when you get your crop in and you want to lock in your price, you can just go ahead and buy a hedge or something that's related to a future, which says, I will sell you this much sorghum in the future at this price that we pre-agreed to. I've hedged it. It could go up and I would lose that. It might go down, I would lose that. Another kind of money market, the next kind of markets that are really significant, kind of the third piece here would be capital markets, and money markets versus capital markets. You know, there's no real law, rule, line in the sand, sign on the wall anywhere that differentiates between money and capital markets. But money markets are where they're trading liquid securities, or something that has less than a year maturity. So think, treasury bills, certificates of deposit, anything like that. Very, very, very liquid, very near cash kinds of instruments. And then capital markets would be, stocks in the company. They could have debt. Yeah, debt trades. So I have a form of debt at my company that we went to Wall Street and we syndicated it out. That's the term we would use. Syndicated it out to multiple lenders, and so there's several people that own my debt, and they can sell or buy it trade it around amongst themselves and others as they see fit. So capital markets would be equity, debt, and those kinds of things. Now, there's a couple of other things that you really need to think about here. One is primary proceeds versus secondary proceeds. And these are, primary and secondary are real words that really get used in the real world. And all that primary means is that the money raised, if it's primary, it goes directly to the company. It goes to the company for the company's use. So the company is going to build a new Dr. Pepper plant in Saskatchewan, and so they go out and raise money, whether it's debt or equity, and they put money into the company, and the company uses it for that. The secondary is that one shareholder, let's say somebody who's buying stock, the new shareholder would be buying stock from somebody who owns stock now, the former shareholder, and that is a shareholder-to-shareholder transaction, and the company doesn't get the money. That is a secondary transaction. So like in my company, where you could buy and sell the shares of my stock, or you could buy and sell parts of my debt, those are shareholder-to-shareholder or debt holder transactions, and they are secondary transactions. Primary comes directly to the companies to be put to use for the betterment of the company. There are also public versus private markets. Now, stock markets would be the biggest example of the public markets. The two biggest, of course, would be the New York Stock Exchange and the NASDAQ, which are very visible. There's lots of stuff about them everywhere. Just massive amounts of information related to them available. There are also very private markets, and you just can't see them. There's not much information about them. And so a bank could originate a large amount of loans and bundle them up and sell them off to somebody else. And you might not ever know, and it's very common. So, for example, a bank might or a lending institution might lend money to you and then sell off a loan to someone else, but then quote unquote retain the servicing of that. And so they would collect the payments, remit that to the ultimate owners of the instrument, etc. And you as the borrower would never really even know that that group you borrowed money from doesn't even own that actual instrument anymore. It is invisible to you. So you know, there are huge amounts of these private markets that you nor I nor anyone else will ever really be able to see, but they're very common. So once again, in finance and in most teaching in universities, they're going to use public companies as examples because the information is public and it's accurate and it's plentiful. So, all right. So why is this so important? I think the last bullet point really says it, is that people with economies with well-developed markets perform better than economies with poorly functioning markets. And I don't know if what's the chicken and the egg. Does the economy perform well because it has well-developed markets? And do economies perform poorly because they have poorly developed markets? But I really think they're totally symbiotic and they go completely together. But the fact is, one of the reasons we have one of the best economies in the world, it's the real strength of our country, is that money moves around very efficiently. People trust the system. Yeah, there's an occasional cheater out there, but for the most part, it moves around with a great deal of integrity, honesty, quality, transparency, etc., and it moves pretty quickly. So, for example, if you wanted to borrow money to buy a house, how many lenders do you think you could find that would be competing to loan you that money? Dozens is the answer. You want to finance your car. How many different ways can you finance your car? How many different kinds of credit cards can you get? This doesn't happen everywhere. It doesn't happen around the vast majority of the world. And so this really efficient movement of money between consumers and lenders to institutions and institutions to companies, and it's really pretty much an amazing thing what we have here, and it is the efficiency that makes it so. The efficiency and the abundance or plentifulness of the capital that's available makes the United States a very attractive economy. If you were going to put your money in an economy, which one would you pick? Venezuela? Probably not right now, right? North Korea? No. Right? So there are places you would want to put your money and places that you wouldn't. And so a lot of the really professional money in the world seeks a home in the United States because of that quality, security, transparency, and efficiency. It's good for them too. So you've probably heard the word derivatives, and it's just something that where it is a financial instrument where the value is derived based upon the value of yet another security. You guys really ought to go watch that movie, The Big Short, and it will explain a little bit of this to you, and it's kind of a mind-boggling thing, but certainly you can bet on the future price of a stock, a bond, a certain commodity, gold, silver, oil, whatever. You can certainly buy futures on those, and based upon which way you think the price is going to go, and those would be called derivatives. A hedge is something that somebody would use. I alluded to it earlier with farmers and grain prices, airlines, railroads with fuel. The fuel is such a huge portion of what they spend to execute their business that they want to know that they have a certain price and they are not subjected to the wild fluctuations that can take place in fuel prices, and therefore they will hedge the fuel. meaning they want to know that their costs are not going to be any more than X. So when fuel prices went up dramatically a few years ago, you may have noticed Southwest Airlines did terrific because they had hedged their fuel prices, and therefore they had a really competitive cost advantage related to their fuel. When a price of a barrel of oil went from $100 to $35, and people had hedged, they had a lot of losses because you have to pay for these hedges. They're not free, right? And so when they paid for the hedge and it went the wrong way, it was not as pretty. So it's mostly you've got to know what you're doing and know what you want to do, because the other airlines, when they hedged the other way, the other airlines that had not hedged as much were able to buy at the new, very much cheaper price, while Southwest was still paying the former higher price. So those kinds of things happen. Now, the speculators get a really, really bad rap because they are just really playing a really high-stakes game, betting on the future of stock prices, interest rates, and in many cases trying to bait the market or chum the waters to get people to do things. And, they may publish reports or analysis and trying to get people to do things a certain way. And they get a pretty bad rap out there. I really honestly can't begin to tell you whether it's all that deserved or not. But anyway, there's speculation. So that's out there in the derivatives side of things. So what are the kinds of financial institutions that are out there? Well, one, commercial banks. Where you go down, I call them the department store of finance, where you want to go down, you want to get a boat loan, you want to deposit some money, you want to get a CD, you want to open an IRA, something like that. They're all there at the commercial bank. Investment banks raise money for you, essentially, and they'll buy stocks for you, they'll trade stocks for you, they'll sell stocks of companies, they'll make a market. But really, the easiest way to think of an investment bank as opposed to a commercial bank is they go raise money for companies. Then you have large financial service corporations, the big conglomerates that would have a commercial bank, an investment bank, an insurance group, whatever, huge financial services corporations. Too large to fail. The credit unions are much more local and hands-on, and they're supposed to be, by the way. There's a fair amount of controversy around credit unions because they try and act like banks sometimes. But everybody's supposed to have something in common. So the Texas State Teachers Association, for example, so that all the teachers would have something in common. And so they could join together and they could pool their money and they could loan money to each other at attractive rates, and they wouldn't have to go through all the banking rigmarole and levels of governance and quality control that drive the price or cost of doing business up. So, they're supposed to be kind of a, group together. You have a reason to band together, credit unions, and that's a good place to go get a boat loan or a car loan or something like that. Now, pension funds are quite different. This is where companies would say, if you work here for 30 years, I'm going to put so much money away for you, and then when you retire, you're going to get paid so much. And so it's retirement money. They're put together these huge pools of money that then they have to do something with, and typically they would invest in others. Life insurance companies, think about people buy life insurance. It's extremely common, extremely useful product, and people are paying their premiums in monthly to have the life insurance. So if they die, the insurance company will pay the family, $200, $300, $400, $500 million, whatever it is, $1,000 to the family to help compensate them from the loss of their loved one and the income implied by their life. So they're sitting on these premiums. People are paying the premiums in, and they're just waiting around to see when they have to pay it back out to when somebody dies, and therefore they have all these premiums to invest. Mutual funds are a group where a bunch of people would hire a manager and they would pool everybody's together, and I might invest in a mutual fund, and somebody in New Hampshire might invest in a mutual fund, and somebody in Wyoming might invest in a mutual fund, and that mutual fund manager would then go out and invest in a certain style or type of stock. So just think of them as pooled investments, where a bunch of people pool their capital, and there's a professional manager. There's a guy named Peter Lynch, ran the Vanguard Fund. He's probably the most famous way back in the day for making mutual funds really, really, really important. And I would imagine that most of you that have anything that resembles a 401k or an IRA would invest in either mutual funds or exchange-traded funds. And exchange-traded funds are people that are just trying to mimic or mirror a certain index. So there's an index out there called the Russell 2000 that my company is a component of. And so it's, what are the 2,000 small cap stocks, and these exchange traded funds would just build a portfolio that replicates that exposure. And if you wanted to bet on, you could buy an ETF on Canadian stocks, or an ETF on oil stocks, or whatever is of importance to you. But typically, it will be large cap, small cap, mid cap, foreign, domestic, kind of exchange traded funds. You could mirror the S&P 500, the Dow Jones Industrials. We'll talk about what all that means later in the course. But you have these exchange traded funds, and it's the easiest way to diversify a portfolio from a personal level, particularly if you have less than $1 million, and the safest way, and in most people's mind in the investment world, the smartest way. Now, you can do really well in those, but there are ways to get higher returns, but it would imply a higher level of risk to do that. Hedge funds are big, typically large, more institutional style investors that would invest in stocks, typically of companies, but really because they're hedge funds, they can invest in anything, derivatives, all kinds of things. There's really no limitations on them. But they're typically larger investors. Can be smaller, but typically they're larger. Now, private equity firms is a different thing. So private equity is a company that raises money from others and then directly invests in businesses. Now, typically not in stocks, but in the business, directly into the business. So let's think of a company that would be not publicly traded, would be kind of typical. It's not, you can certainly have both, but let's just use the most common example. A private equity firm, one of the biggest in the world is in Fort Worth, TPG, Texas Pacific Group. They have operations in Texas and California, and they would invest in companies, and they would buy the company, buy a majority interest in the company, help grow and improve the company, and then typically sell that company again in 3 to 5, 7 years. So private equity firms. So all of these are very different things, and they're all financial institutions, and they're all real, and they're all part of this efficient movement of money. One thing you might think about is in investing in money, whether it's you running a business or if you are at some sort of institution that supplies capital in the future, you want to match as much as possible this notion of matching assets and liabilities. So on life insurance companies, that the source of their funds is insurance premiums. And so they expect to collect premiums over a number of years and don't expect to pay the life insurance until many years in the future. So their source of funds is long-term, and therefore they like to invest in long-term assets, which is why you would see life insurance companies very often being lenders to large commercial real estate projects. Long-term source of funds, long-term asset class. Private equity, their sources of funds are limited partners, LPs. Remember that notion of LPs that we talked about in entity structures? Their partners are typically institutional investors. It could be the Yale University Endowment Fund, the California Teachers Pension Fund, large institutional investors that want to have some access to their money in fairly midterm kind of time horizon, and so it's a midterm source of funds. And these funds typically have a finite life to them, so that they are supposed to only be alive for so long, let's say 10 years, for example, and therefore it is a midterm source of capital, so they look for a midterm place to invest the capital, which would be in buying or owning a business for 3 to 7 years, for example. Commercial banks, their source of funds are your deposits, which you could walk down to the bank today and say, give me my money, and they would have to give you your money. Or they borrow from the Federal Reserve, we call it the Fed, which they might borrow overnight, by the month, whatever. So their source of funds is direct, very, very short term. So banks want to loan you money. You know, if you're going to go borrow for a car or something, you want to loan you money for 3 years, 4 years, 5 years, something like that. Typically, they don't want to go out very long because their source of funds is much, much shorter term. There are differences between some of these types of physical location stock exchanges versus electronics. But really, for the most part, as you as an investor or you as a financial person, there are differences, but it's almost invisible to you. And how they trade and why they trade and what they trade, there are nuances. But for the big scheme, in the big scheme of things, they are very much the same. So the two that you'd be aware of was the NYSE versus the NASDAQ. From an investor standpoint, extremely similar. My company happens to be listed on the NASDAQ, but it could be listed on the New York Stock Exchange, and I don't think anyone that invested in my company would really see any difference. So the NASDAQ is an electronic exchange, where the New York Stock Exchange is still a physical location stock-based exchange, but most of the trading still takes place in a data center in New Jersey somewhere with bits and bytes, just going through data centers. There's a notice exchanges versus over-the-counter. Over-the-counter, that's what OTC means, is it's much smaller stock, less trading. And it's called over-the-counter because people used to physically walk up to a counter on one of these exchanges and say, I have an order to buy 300 shares of your stock number 56, and they would sell them to them right there over the counter. Where exchanges are much more electronic driven, etc., where you can see the prices real time online. There's a thing called a bid and an ask, and all that really means is, if you see that, is that someone is bidding, I'm willing to pay $1 per share, and the ask is, well, I own the share, and I'm asking that you pay me $1.20 a share, and that's the bid-ask spread. When bid and ask equal, you can have a transaction. Pretty simple, right? That's for stocks or anything in life, I guess. Now, stock market transactions, there's existing trading. If a company's already listed, I used Disney as an example. Disney, ABC, ESPN, all the Disney properties, etc. Existing stock trading, it's already public. The shares are already out there, and if you want to buy 100 shares of Disney, you just call up your broker and say, I want to buy 100 shares of Disney, and he goes and gets them for him, and makes the transaction take place. And so, since it's going from somebody who owns stock who wishes to sell to somebody who wants to buy stock, that's a secondary transaction because the money never went to the company. This shareholder to shareholder. Now, the company raised money, and that would be obviously a primary transaction because the money's going to the company. On the equity side, not loaning money, not where you're going to pay an interest for, but people just make an investment in the stock of the company. There are two primary ways. One is an IPO, an initial public offering, which means that really only happens once in the company's life because it is the initial public offering of stock. An IPO, homework is going to be based around IPO, so Pay attention here. And then follow-on offerings is if you're already public and people are already trading your shares, but you want some more money, you want incremental equity money to come into the business, you would go have a follow-on offering that would be led by an investment bank because they go raise money for businesses. They know where the investors are, they know how to contact them, they know how to work the process in an efficient way. The company needs money, put the story together, you go out, pitch it to the public, right? Or to the shareholders. So what is an IPO? An initial public offering, as I said, it's the first time that you would issue stock. And going public gives them the ability to raise capital theoretically in a more efficient way. People find investing in the company more attractive because there is a much easier way to sell their position. If you invested in your cousin's restaurant, it's pretty hard to sell your position. But if you have stock in Disney, you just sell it, right? And so it gives the company much greater ability to raise capital because there's a great deal more liquidity of that ownership. It's much easier to buy, sell, and trade. Liquidity, financial word of the week. But if you go public, then your stocks trade on the public markets. But because you're public, you're going to be subject to a great deal more of regulations and reporting requirements, and what is implied by regulations and reporting requirements is cost. It is very expensive to be a public company. So you've got to weigh the pluses and the minuses. There are indices out there that help you tell what's going on out there, and these are things that you will hear on a regular basis. The Dow Jones Industrial Index, if you happen to be listening to the news and they say, well, the Dow Jones was up and S&P was up, what the heck do they mean? So when they say the Dow Jones Industrial Index, all they mean is very large companies, huge companies, behemoth, Coca-Cola, ExxonMobil, 3M, Apple, big, huge companies, certainly not companies like mine. And there's only 30 of them. Why they quote that all the time is that's the one that's the big be-all, know-all, see-all, not sure, but that's the one people quote all the time, I guess because it's simple. The S&P 500 is much more the standard benchmark for U.S. stocks, and it would be the one to tell what's going on with U.S. company performance. They are clearly large cap stocks. They are that is an index of the 500 largest companies, not the 30, but 500. So it's much more broadly based, much more realistic, and much less concentrated. And it's kind of this benchmark or industry standard. Kind of the next index that would be of note would be the Russell 2000, which is the 2,000 largest small cap stocks. Small cap means small capitalization, or how do I say this? Small value. They're just worth less. But you know, the 2,000 largest that aren't, and those above. But if you want, typically the returns in the small cap stocks are much higher, but the volatility is a great deal higher, so they are riskier, even though the potential for a higher return exists. We'll talk about that later in the course as well. So, and then the NASDAQ composite is just all the stocks that are listed on the NASDAQ. They used to have a great deal of relevance when the NASDAQ was kind of tech heavy, very tech centric in the companies that listed there. It's just not the case anymore. I'm not a trucking company, and we're listed on the NASDAQ, because there are several other trucking companies. So it's not what it used to be, but still people quote it a lot. So those would be, you know, 4 indexes that you would hear. So if you bought an index fund or an ETF, they might track to one of these 4 indices here. And if you bought the NASDAQ, that'd be a pretty basically broad-based group of stocks from a wide variety of segments of the economy. So it'd be a pretty interesting ETF to own, frankly. And then, you know, how do they do? So this is S&P index from 1968 to 2014. And the moral of the story is here, sometimes they're up and sometimes they're down. No, it's not always up. You can lose money as well as you can make money. Typically, it's up more than it's down, but that's because the U.S. economy has been consistently so strong over a long period of time. So what does it mean by efficiency? Back to that notion that we talked about last time of equilibrium. Highly inefficient stocks are ones that aren't followed by many analysts, and they don't have a lot of contact with investors. What does that mean? So there are 4 people out there that are professional analysts that meet with management. They look at our financial statements. They ask us a lot of questions. They build financial models on us, and then they publish their results. They are analysts. There are 4 of those that follow my company. I don't know how many people follow Walmart. Dozens and dozens and dozens, right? And so if you think of a really large company, lots of analysts, lots of information out there, be highly efficient, highly transparent, and then smaller companies, the fewer analysts that crawl into their hole and don't talk to investors, which, by the way, we do. We talk to investors frequently, but some small companies just don't. They would be inefficient because you just don't have much information. And so essentially the point is the more transparent the company, typically the more efficient the company is, and the better for the investing public. Now, if you had a market efficiency and you hear in the news that somebody just received FDA approval, can you expect to take advantage of this information by purchasing this stock? Well, my opinion is somebody is ahead of you, and maybe you can, but you're not going to catch the first wave. You might catch it from the bottom of the trough up to the top. You might catch it part way on the way up, but you're not going to capture all of the return. But there are certainly times where if everyone had all the same information at all the same time, they could all get the same return. Now, there's a homework this week. It's not due this Tuesday, but kind of a week from Tuesday, because I'm posting this early. And then there's a spreadsheet to fill out and a discussion. Now, one of the things you're going to have to do is you're going to have to go get some stock price quotes, and where do you find that and what does one look like? I'm going to show you where to find all of this online, because this is an online homework essentially that you have to just fill in your results. And we're going to go out and we're going to find some stock quotes out here. This is one for Twitter. That's what it looks like. Let's see what I've got here. Here's one for Yahoo Finance, and that's where we're going to go. We're going to go to Yahoo Finance, and we're going to take a look. All right, so let's get rid of that, and let's come over here. Okay. So this is Yahoo Finance. If you'll just type in Yahoo Finance into Google, it will take you straight to it. And let's just look for a company. Valvoline, they sell motor oils and stuff, right? Everybody knows what Valvoline is. It comes here and it tells you what the stock price is. Let's go to the summary first on Valvoline. If I can get it to come up. What's going on? There we go. So this is a stock price chart. This happens to be 1 day's trading. You can go to 5 days, 1 month, 6 months, year to date, 1 year, 5 years. Let's look at 5 years. It only goes back to 16. It's because it IPO'd last year. So here's 1 year's trading stock. So I can see on this particular day what the closing price of that stock was. These peaks and valleys here are what was the volume, how many shares traded, and what's the price of that stock. Excuse me, I'm trying not to sneeze. I could also come down here and see what the market cap is, which means what is the equity value of the total shares of the company that are owned. How much is it worth? It's worth $5 billion. You can tell what the bid and the ask, if there is one today, but you know, this is a Sunday morning when I'm posting this, so there's no bid and ask. What's the day's range? What's the 52-week range of the price of the stock? What's the volume today? What's the average volume? This is how many shares are traded. It also would come down here and give you a number of news stories about the company, and that's just in the summary section. I think a really interesting place to go is the profile section. You come here and it tells you where their headquarters is, who the key executives are, how much they got paid, how old they are, bada bang, right here, just in public all in one place. Tells you where their headquarters are, gives you a description of the business. You know, automotive and industrial lubricants. Here's the segments it operates in. Here's what your, you know, corporate governance score is. It's a 4. All right? And here's another thing. Guess what? Right there, financial statement. What? The financial statement? Yeah. Do you want to see the income statement, the balance sheet, the cash flow? Here's the income statement. I don't know. Come on, roll over here, buddy. I don't know why that isn't populated. Let's see if we can get to see if we get the balance sheet up. Oh well. Typically, it would be right there. And also, if you want to know who the big people who own the stock, here's the holders in the stock. So why am I getting the balance sheet? Come on now. Here we go. Who owns the stock? Here are major shareholders, you know, held by insiders, institutions, float, number of institutions. So here are people that directly own stock in their own name. Many times they will be officers of the company. Here are some institutions that own it. Evercore, State Street, Goldman Sachs, TIAA, CREF, T. Rowe Price, Vanguard, BlackRock, all companies you've probably heard of. And then the mutual funds that we talked about before, these are mutual funds that have this as part of their portfolio. So the JP Morgan Small Cap Equity Fund would own a portion of this. Now, how much do they own? Pretty interesting stuff. So let's see if we can find something a little cooler. Twitter. So we go to Twitter, and you can see, let's see how their stock's doing. And I'm trying to go to summary. There we go. And if I want to know over the last year how Twitter stock has done, it was, wow, something happened a year ago, and that thing really peaked up, and since then, it hasn't performed very well. So I can see on the 20th of July that their stock price ended at $20.53. And I can see on the 12th of July, it ended at $19.25. Pretty amazing stuff. You know, you can go to the profile, you can see, you know, what people are making, how old they are, and something about the company, etc. So if you wanted to know what the price of the stock was at the date of an IPO, you could just do it. Financial statements, let's see if it'll populate for me here. Yeah, there's one. So you can see you've got kind of 3 years of financial statements typically in a table right there for a company. If I was in a college business, I would want to know that this existed and this was out here. Now let's check one more. I'm just going to come in here. I'm going to, just for fun, let's type in Dasky and see what comes up. All right, I'm at $13. Let's look at my summary. This is my company, by the way, where I work, and I'm trying to get to the summary page. And let's go to 1 year. And it only goes back to the beginning of March because that's when we began trading publicly as the SKE. So 6 months out, you can see we came out probably right at first, you know, $10.21, and today we're trading at about $13. So 30% stock price appreciation in 6 months, if I don't mind saying so myself. But you know, here's something about our company, the equity value, you know, just the net. What's the company worth to its owners today? It's worth about $500 million. And then if you want to come down and see, you know, there'll be advertising in here. I'll say sponsored. I'm sure you're familiar with that. But if you wanted to see something about our company, This says this is somebody publishing on the fact that we acquired a company on September 1st, and this is an ad from, an article talking about that and saying what's some of the characteristics of what we acquired. Something we did on our loan. We had an earnings call. Where we report to the public what we earned. Just huge amounts of information right here on the company. And then let's go back up and take a quick look at the profile. And you can see here's our headquarters, there's our website, here's the key executives, that's me. Now you know how old I am, you know what my base salary is, because it's just public information. And then once again we have this, what's the description of the company, right? And I don't know, given how new we are, since we're so new, they just haven't published any realistic financials here. So let's see if we can see who the holders are. Is it going to populate? Yeah, okay. We are very unique that we have a huge amount of insider ownership, which means that the people who are running the company own the majority of the company. That's very unusual for a public company. But we're not populating the rest. We're so new, there's only so much that's going to be out there. But the point is that you can find a huge amount of this information out there. For the homework, I want you to look up these companies right here. These are the 5 largest IPOs and that came out last year. So what kind of business are they in? U.S. Foods. It will be in that profile section. It will tell you what business they're in. So just put a very simple description. This could be, MGM Growth. I don't know what that is. It could be hotels and casinos. This could say food service supply. ZTO Telco. I don't know what it is. What was the price that they offered it for when they began trading the first day, and what did it close the first day? And that says 14, but I really want this to say, excuse me, F2. I don't know why it's not taking it. Let me see. It should say 16, excuse me, right? So what's the stock price on 12/31/16? And I will fix that in whatever in DocShare. So just fill that in, and then I want you to list the name and compensation of the CEO of each one of those companies. Okay? And if you want extra credit, tell me how many IPOs there were in 2015 and how many IPOs there were in 2016. Okay? All right, that's it. Sorry I had to post this, and we will talk to you later. Thank you.